I have a unique relationship with inflation. I have lived for years in an inflationary economy. I have watched for decades as friends and family who I love, who still live in that economy, have watched their retirement nest eggs get cracked, scrambled, and eaten by inflation. And I look at the US and realize that the financial underpinnings that we all rely on for retirement planning are broken when it comes to inflation specifically. We're not prepared for it. We don't think it's as big as a risk as it is. No one's talking about it. And the solutions that they do have when they talk about it are crap. I forgot to introduce myself. My name is Jeremy Watson. Over the past 25 years, I've started 30 companies. Currently, I am running 7. I've spent 10 years adjacent to financial advice. In that time, I was consulting full-time on about $300 million. I'm going to share as much good knowledge as I can for free, hopefully to do some good in the world while sharing some interesting stuff. If that interests you, follow along. I appreciate you watching. One of my major gripes with financial advice while I was in that field for 10 years is I didn't feel like what's called modern portfolio theory, what's standard in financial advice, that it wasn't addressing inflation hardly at all. Like in all the classes I took, and all the continuing education I took, and all the professionals I spoke to, they act like inflation just isn't an issue. That's because inflation hasn't been an issue in the US since the 70s. It's been 40 years of non-inflationary times. If you look back at the 70s, some old timers, they have concern about it, but they seem to be like, okay, we've figured that out, we've licked that. And I just don't think that's the case. I do not think it's the case that we've got inflation figured out. I think that we have a ton of US monetary policy and global monetary policy that has insulated us from inflation. Like just being the world's reserve currency alone has insulated us from inflation. And a ton of our global and US monetary policy have just kicked the can down the road and made it possibly infinitely worse. And my biggest problem is, I think it is a much bigger problem than people know, and I don't think modern portfolio theory addresses it. I don't think current financial advice in the paradigm in the US of A addresses inflation. I just don't. The only way that they say it addresses inflation is that if there's inflation, stock values will go up. And that is true. Stock values will go up. But in retirement planning, you're talking about people who are in retirement and who are moving gradually their portfolio more and more of a percentage into bonds. And inflation's destroyed bond values in a way that is hard to describe. So I just don't think that modern portfolio theory addresses inflation in the US of A in a way that I'm at all comfortable with. What has developed in its place instead of a comprehensive solution for inflation and what asset classes do well is people who are really concerned about inflation have just gone to gold. 100%. Hey, if you're interested in this, buy gold. If you're interested in this, buy gold. If you're interested in this, buy gold. Today, gold's like at $5,000. It's gone through the roof after the Trump tariffs, which is a whole different thing that we'll have to talk about. But the bottom line is the solution for inflation in the USA has become just buy gold. And that's a really bad retirement plan. It's bad on its own level because it produces no income. Any retirement asset that you have, you should not have to sell the asset completely. You would hopefully have some stocks with some dividends or some real estate with some rent. You would hope to not have to eat the nest egg to survive one more day. You'd hope people draw down on it. Inflation can destroy any income asset in the US. It can destroy any of them. It destroys Social Security, it destroys pensions, it destroys fixed income annuities. We should at least understand that our retirement assets need to be able to adjust for it. That we're at least planning our retirement assets to be able to handle that in some way. Real estate, in my opinion, is that solution. I don't think there's another great solution out there when it comes to inflation. I'm going to be candid. Gold is great if you can put it under the bed. The problem is it doesn't pay you as you go along. And the reason real estate is so magical when it comes to protecting against inflation comes down to two fundamental relationships. And I'm going to try to graph these out for you. And I'm going to try to help you understand. However, and this is how blind the country is to this. I have done at least 30 hours of research preparing for this webinar, at least 30 hours. where I've read articles and I've looked up stuff and I've watched people talking about this and I've watched economists and I've lived inflation when I was young. So I knew this was a problem and I've experienced it in my own life in a way that most Americans have not. I have not been able to find almost any good visuals to illustrate these points. I've had to create them myself because no other financial services firm that I can find is publishing anything on this topic. I'm going to try my best to help everyone see why real estate works so well as an inflation hedge and a retirement asset in inflationary times. It comes down to two relationships. Number one, your mortgage balance versus your property value. How much I owe versus how much it's worth. Okay? And the second relationship is your mortgage payment versus what is current market rent. How much I have to pay to hold on to the asset versus how much does someone else have to pay to live in the asset. Those two relationships really matter when it comes down to why would I maybe consider having a piece of real estate to help me with inflation. If inflation's coming, why would I consider buying some real estate that I might not have considered before this call? Real estate, not gold. Real estate goes up in value with inflation. Mortgages go down over time. All right, your mortgage balance will go down over time, but the value of your property is going to go up with inflation. We're going to look at a couple charts and show that, okay? Rent goes up with inflation, where mortgage payments on a piece of leveraged real estate go down over time. And real estate is going to pay you the whole time. It's going to pay bills the whole time, where gold only pays you if you sell it. And it's effectively only worth what the dollar would have been worth had you held it in gold. So it keeps up with inflation, but it does not pay you the whole time. Real estate pays you the whole time while the asset goes up, while the cash flow goes up. That's what we really want from a retirement asset. We don't just want something that's going to sit there under our bed and only be worth what we paid for it in 15, 20 years. That's what gold does. We want something that's going to pay us the whole time and keep up with inflation and maybe even do us a little bit better. Okay, so number one, the mortgage balance versus the property value. I just pulled, there's so many of these charts out online. I pulled this one from Colorado. This is what you want, you know? You want to buy in any point in any market, no matter where you buy in, you want to buy any piece of real estate, basically anywhere. And if you see inflationary times, those values will go up. Now, some real estate's going to go up hotter than other real estate, but we just want to be on the correct side of this bet. We want to buy, understanding that it is an asset and that as inflation hits, the asset value will go up. Same as gold. As we see inflation, gold is worth more. As you see inflation, real estate is worth more. Just look at any piece of real estate you have ever bought in your life, and you will be like, yes, real estate does go up based on inflation. He's right. It goes up based on inflation. So in that one regard, it is very similar to gold. Here's the fundamental difference. If you buy this little house, and I know these are slightly different houses, but there's meant to be average home buying in the US. If you buy this original house for $39,000 and your mortgage is $35,000, right? That's your mortgage. In 20, 30 years, your mortgage will have gone down to $15,000. Where in 2014, that same asset, they're saying is worth effectively $450,000. So my mortgage is still only 15, but the asset has gone through the roof. That same average house will have effectively a mortgage payment where we bought it at $346,000. Now that same average house is renting for about $2,600. So my rent went up. My mortgage payment stayed the same. My value went up. My debt on the books with the bank went down. So inflation helped this person in every regard. And you can just ask yourself the question, if I had bought this house back in the 70s, 1970, and if I had a mortgage this whole time of $346, and over the years, my rent had gone up, 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 and now it's at $2,600, right? That means that as everything got more expensive, I would have had more commensurate cash flow to deal with that. And if I had spent $35,000 back in 1970 and slowly been paying off my mortgage, and now I only own $15,000, but the value of my asset went up, 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 up to $470,000, I am much richer on paper. At the very least, my assets are worth effectively the same once I adjust for inflation. The difference is gold doesn't allow me to do this. Gold does not allow me to buy at 80-20 leverage. The bank is not going to lend me 80% of the money to buy gold. I'm going to have to put $100 dollars into my gold. I'm not going to be able to lock into a 30-year fixed mortgage to buy my gold. And my mortgage payment for that house, instead of buying gold, I could have a fixed, locked-in mortgage payment while rents do increase over time with inflation. So I have more net spendable income, more net spendable income, more net spendable income. Every time inflation rears its ugly head, I get a raise. Every time inflation rears its ugly head, I owe slightly less because the time's going by, but on my balance sheet, I'm worth more. Real estate, you are helped with inflation, not hurt with inflation, and you can pay your bills over time because it's paying you all along the way instead of gold where it really, really isn't, right? Here's an example. If I bought in 1977 that I had to draw because there's no one in the industry who's having this conversation that I could even find. If I bought this house at 1977 for $45,000, my mortgage balance would have gone down over time, where the value of average homes in the US went up, 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 big dip after 2008, up, up, up. You can see the value of the home went up, the value of the home went up, the value of the home went up. There was even a huge dip. What I'm saying is there's a relationship between how much the property is worth, the property value, that's the blue line, right? And what our mortgage balance is, that's this bottom red line. Your mortgage is getting paid off over time. You owe less money on your balance sheet, where the asset is inflating away. And look at that top orange line. That top orange line represents inflation adjusted prices. And so you can see it's a lot less crazy than the blue line, because effectively what's happening here is the property is adjusting for inflation. It's worth effectively a little bit more than you bought it for. But that trend line is so much less than the blue line because property adjusts for inflation. Because when there's more money in the economy, people pay more money for houses. I think everyone has seen that and say, okay, well, 77 might be the perfect year to demonstrate this. What if we bought that property in 87, right? You would have paid that same property off by 2017. So your mortgage balance, again, goes down over time, where the value of the property goes up, up, up over time. On my balance sheet, I owe less. On my balance sheet, my property's worth more. That's exactly where we want to be as far as an inflation asset goes. And what if I bought my property in 2017? Some people might be saying, well, I'm too late to the party. Number one, I don't have good math for that. We would still be barely paying off that mortgage, that decline line, but you can already see property has gone up really substantially since 2017. Was always thus, will always be thus. Okay, like property goes up over time if there is inflationary pressure, because it is at the end of the day an asset, and that asset goes up over time. So your debt goes down, your asset value goes up. That's the right side of the bet. Before we go farther, I want to give you a little bit of an intro to the channel if you're new here. This is an entrepreneurship channel, and maybe a little bit of a guided tour of the type of stuff we do and why you might like it might be helpful. If I was to start anywhere on the channel right now, I would start right here at Trump's Tariffs Explained. One of the 7 companies that I own is a bandage company. It's called Crash Pads. We import directly from China. So the day after Liberation Day in 2025, we did a video talking specifically about all the intricacies of how Trump's tariffs affect my business, my bandage company. And what I did was I got a whiteboard out and I just walked through all of the different pieces of Trump's tariffs and how they affect a small business, from profitability to pricing a product to building a supply chain to employment to sales taxes to who pays the tariffs. And if I'm honest, I think it's one of the better explanations of how tariffs affect an economy of anything I've seen or heard. And it did really, really well. And we just walked through all of the intricacies of that. If that doesn't interest you, maybe you'd be more interested in enormous rehab. I've always loved rehabbing houses. This is the biggest rehab I've ever attempted. And I've flipped at least 20 properties over the years. But this rehab cost us $1,060,000. It's going to be years of work. It's a big, gorgeous, interesting, complicated rehab. And we're letting people follow along the entire time as we rehab the whole thing. It's an incredible project. It's got it's big 6,000 foot McMansion, and it's got this beautiful sliding rock feature into rivers. It's a fascinating project. If you're just interested in, hey, real estate investment, how do I get there? This video, Never Buy Rentals Here, is the simplest math that I can do to help people understand what makes a good rental and what doesn't. Where are markets that make sense and where are markets that don't make sense? If that interests you, feel free to look around, but it's an entrepreneurship channel. There's a bunch of different pieces. It's not just real estate. It's not just efficiencies. It's not just Turo. It's not just flipping. It's not just Airbnb. It's all of those things, because I own companies right now that do every single one. Number two, the second major relationship that matters is the mortgage payment versus the market rent. And this can get confusing, and no one else is having this conversation. So here's what I want you all to be able to see. This is a chart that I was able to find that shows the average cost to buy, aka a mortgage, and the average cost to rent, aka rent, right? What you can see on this chart is that over time, both have gone up. Woohoo! Big whoop, right? Big whoop. But what I'm trying to say is you want to buy here. You want to buy when your mortgage locks in at, now, $225 a month, and your mortgage stays the same for the next 30 years, because your mortgage payment, if you're doing it right, is on a 30-year fixed interest rate. It's never going to change on you. Your payment's going to be $400 a month forever, for 30 years, while rent, this red number, goes up. So we want to be in a position where we're paying $260 a month for our note, but the rent is now up to $1,800 a year, because that creates a substantial cost of living increase that's directly keeping up with inflation, right? If inflation goes up and the dollars become less, the rent will cost more. We get to renegotiate that every single year. Every single year, we're going to put a new lease on the property. And if you go and research this on your own, you will realize that rent payments have gone up substantially since 2017. Not because every landlord is greedy, but because landlords' fixed expenses have gone up. Eggs have gone up. Gas has gone up. Homeowners insurance has gone up. There have been upticks in expenses, and that rent has gone up to compensate for that. And so they have at least as much money as they ever had. The beautiful thing about being a landlord with a 30-year fixed mortgage is the mortgage has not gone up. The debt maintenance has stayed the same. And so that's the magic of it. Get a fixed interest payment on your property and let rent go up over time. The difference is just living on money because everything costs more. Okay? Another example of that, if you bought a house back in 1960 for $11,000, now it's worth $380,000. The average cost of the home in the US. The average rent slash mortgage in 1960 would have been about $70. Now it's about $2,000. Again, the asset's going up over time, the rent's going up over time, the mortgage is getting less over time because you're paying it off, and the mortgage payment is staying the same over time. I have a bunch of different ways to show you that, but I feel like I've made this point pretty clearly, so we're going to skip on and keep moving. The 30-year fixed mortgage may be the ultimate tool to fight against inflation. The fact that there is such a thing as a 30-year fixed mortgage is baffling to me, because I do not believe it represents the amount of risk that banks are fundamentally taking. I'll give you this mental exercise. Just imagine for a moment that you are working and you're saving. Like the average well-to-do American may be able to put away $20,000 a year if they're saving, maybe $50,000 a year, maybe $70,000 a year. I'm going to say $50,000 a year. How much money can you really save in a year after all the expenses and all the taxes and raising your family, paying your mortgage, right? How much can you really save a year? 50 grand. That's a good saving year for anybody. How much would I have to pay you to borrow $500,000 to go buy myself a house? How much would I have to pay you for 10 years of your hard-earned savings, assuming you were going without and you were really, really saving and you were really putting it all on the line and you were going without some things you wanted to do? How much would I have to pay you in interest to borrow $500,000 to buy myself a house? I would bet money it's more than 6.8%. It is absolutely more than 3.65%, which we were at for almost a decade and a half. This rate that people got used to was artificially low. It was only ever there because the government was printing money and artificially suppressing that rate. This rate is still artificially low, and that's why when you look back at the 70s and the 80s, you'll see the interest rates were in the 14, 15, 16%, because the government had not rolled out Fannie Mae, Freddie Mac yet. The government had not started artificially lowering interest rate yet. The government had not established a secondary market where mortgage-backed securities were being sold yet. And by doing that, they were able to drive down interest rates on 30-year fixed mortgages artificially low for my entire lifetime, since the 80s. The important thing to understand is that those rates are still low, and the fact that a 30-year fixed mortgage even exists is incredible. It's like the ultimate tool for financial wealth. And it also is the ultimate tool to fight inflation. I don't want to spend too much time on that. Now, people are going to ask, but what happens if rates go back down? Like, rates are high right now. I hear that all day, every day. Again, Bedrock helps people buy real estate. We're getting to that. Bedrock helps people buy real estate. And the bottom line is we deal with interest rates all day, every day. So there's only three things that can happen if interest rates change. There's only three options, right? They can go up. What if they go higher? Okay, let's say I borrow at threes are the old days. Sorry. Let's say I borrow at 6.8 right here, right now, to buy a piece of investment property. What if they go higher, right? Well, then I will be grateful that I got at 6.8. If interest go to 15%, I'll be grateful I've got at 6.8. Note, I'll look back at that fondly in 20, 30 years. If interest rates go to 30% or whatever the crap, I will be grateful that I'm locked in at 6.8. If they go higher, I will be happy. What if interest rates go lower? If interest rates drop to 3.5% again, I'll just refinance it. I'll pay the fee. I'll pay the $2,000-3,000 to go and refinance that mortgage and get a new lower rate happily. And the other thing that can happen is nothing changes. They just stay at 6.8 forever, at which point I'll be pretty happy I bought a piece of real estate at 6.8 that was a good cash flowing asset. So they can only do three things. They can go up, they can go down, they can stay the same. Any of those situations I'm totally fine with. I would rather buy a good cash flowing asset today and ride the inflation wave and let it go up in value, let my rents go up, then stay on the sides of the market because I'm waiting for interest rates to go down again to 3.5%, again, because they are not actually that high. They are artificially low still because of the way the government subsidizes mortgages. So with that being the case, I've always loved real estate. Okay, over a decade in financial advice, consulting on almost $300 million. This is what I saw. This was the portfolio breakdown that I saw. 20-30% of people's portfolios was in their 401ks, stocks, or bonds. The majority of the wealth I saw was in real estate. 60-70% easily was in real estate.
When that many people have all made the same decision to say, hey, getting a piece of rental real estate and letting it inflate over time, getting a piece of rental real estate and adjusting my rents over time, getting a piece of rental real estate and paying off my mortgage over time, if that is just what I saw time after time after time, I cannot even tell you how many times I've seen that same story told. That people throughout my entire career who bought a good piece of real estate and then just let it be. That's the same argument for gold. The same argument. It's just buy it and set it under your bed and let it be. Now, you have to deal with real estate. And I realize that is the one big, but Jeremy, you got to deal with it. Bedrock will deal with it. I run a whole company. We've helped people buy like 5,000 houses. We deal with hundreds of properties a month. We deal with property management. We do the LLC setup and compliance. We do the administrative. We hire the property manager, vet the property manager. We keep the property manager honest. We keep the operating capital account up. We just let you know if there's an issue, right? So there's ways to do real estate that's still really passive. I'm just saying, if I had $100,000 right now to invest, and I was either going to buy a piece of gold or I was going to put a down payment on a piece of real estate in an inflationary market where I'm concerned about inflation, which we should be, I would buy a piece of rental real estate on a 30-year fixed mortgage 1,000 times out of 1,000 for all the reasons I've said. Because even though it seems counterintuitive, when you look at it piece by piece, you realize real estate will pay you the whole time, gold will not. Real estate will go up in value, so will gold. Rent will go up over time, but your mortgage payment will stay the same. There's just so many pieces that are so enticing. And candidly, if this interests you, you should just book a call with Bedrock. The number is 833-255-0055. Just book a call with us. Have a conversation. If it's not the right fit for you, it's not the right fit for you. But feel free to just get on our calendars and have a conversation around what is good in the market right now. If you're thinking there's nothing good in the market, now is not the right time to buy real estate, you couldn't be more wrong. The question is, if you're wrong, would you rather know now or would you rather know in 30 years? So, those are the reasons that I think real estate just kicks the ever-living crap out of gold in every way that matters. I hope you enjoyed this. If I was picking one video to watch based on this video, I would actually go and watch this one right here, Never Buy Rentals Here. At the end of the day, I look at rental property just a little bit differently because we've done so much over the years. And because we've bought in so many markets, we've bought in probably 15 major US markets, about 5,000 homes. Because I've done so much of it, it starts to just be a house is a house is a house, right? We're just looking for houses that work, where the returns are good. With that being the case, there are ways to compare markets apples to apples. There are ways to say, hey, which market is fundamentally better? Because what you realize over time is the markets define what's good. I can tell you right now, almost nothing in Northern California is going to cash flow positive. I can tell you right now, almost nothing in Southern California is going to cash flow positive. And it's because those markets have hyperinflated and the rent doesn't work. If I wanted to go from this video and look around and see what else is in the channel, I would watch Never Buy Rentals Here. It's a spectacular walkthrough of one number you can get to really easily to figure out, is it a good deal or is it not? I'm going to put that right here. I'm going to put that like right here.